Hello and welcome to joining eOption's webinar. We're excited to have you here and thank you for taking the time out of your day to join us. We're excited to partner with Teddy Kestat again, a professional trader with over 30 years of experience, to bring you this webinar today on Do you think you're priced out of the market? Think about options. My name is Gina Bocayas and I'm with eOption. And just to provide some basic logistical information on how this webinar will work today, the session today will last approximately 1 hour. Teddy's presentation is about 40 to 45 minutes, and then we'll take your questions at the end. You will see on your screen there's a Q&A box, so feel free at any time during the presentation to enter your questions in there, and Teddy will do his best to address all of them at the end of the presentation. You'll also see a chat box, but we ask that you put your questions in the Q&A box and not the chat box, as our speaker will not be able to see those in the chat box. And also, after today's session today, if you have any questions at all about the content or specific strategies, please feel free to call eOption's trade desk at any time, and our experienced professionals can assist you. And a popular question that's often asked is if there's a recording that will be available of this. And yes, we always put them on our website within a week after the session. And you can just go to eoption.com, and we do have a tab called Webinars and Videos that it will be directly there. So for those of you just joining, we'd like to welcome you to our webinar today on Do you think you're priced out of the market? Think about options. And as eOption's name implies, we are a firm that specializes in option and stock trading. And we do charge some of the lowest option rates in the industry. Our options are just 10 cents a contract plus $1.99 per trade. And all stock and ETF trades are commission free. We also offer other products such as mutual funds, fixed income as well. So we also support option education, and we're glad you can join our webinar today to learn about using options to trade in this volatile environment that we're in. So now I'd like to turn our attention to our speaker, Teddy Kestat. Teddy has over 30 years of experience in the financial industry and has also worked as a professional trader. Some of you may recognize his name from past webinars he's done for eOption, and we're very excited to welcome him back today. And to tell you briefly about Teddy, he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. He's been an institutional market analyst for over 25 years, and he's currently president of Forex Trading Unlocked. He's also an author, and he's written a book called High Probable Japanese Candlestick Patterns. And he also has a degree in finance from DePaul University. So without further ado, I'll turn it over to Teddy Kestat, and we'll get started. Thank you.
Thank you very much for that introduction, Gina, and thank you, eOption, for sponsoring this webinar today. And let me just get this slide going. Here we go. So do you think you are priced out of the market? Think about options. So we're going to skip past my little documentary since Gina already did it. So we're going to first show up our disclaimer to remind you that this webinar is for illustrative and educational purposes only. So please take a moment to just read this real quickly and just look it over. And there's information if you have any other further questions on it as well. And then I always have mine from Forex Trading Unlocked as well, but I can just briefly skim over that because we already had the other one. So maximize your option trading potential. Use eOption for your stock, ETF, and options trading. You have the ability to get a free option strategy tools from their website, like their options play. You also have their free option strategy guidebook, which is also available at eoption.com. And you also can start your own paper trading account also to test your option strategy off of eoption.com's website as well. So one thing you want to remember is the ETF and stock trades are commission free, and options, which we are going to talk about today, their contract commissions are only 10 cents per contract. So we are going to talk about what you will learn today. So we're going to talk about how to trade the big stocks without large capital allocations. I'm sure a lot of the names that we're going to mention today are very familiar to all of you. Even if you're not familiar with options trading, I'm sure that you are very familiar with these names, these equities that these options are going to be based off of. So one thing you can do with options is you expand your portfolio diversification, which is something everyone wants to do as they begin to grow their portfolios, no matter at what level you are at, whether you're beginning or even advanced. So then we also going to talk about how to maximize your potential returns with options. So you can have with options, they are a mechanism for the markets in which you can maximize your return on your investment. And we're going to discuss that as we go through the examples today. And then we have this simple option trading strategies that can increase your odds of success and protect your trades. And so that's what we're going to talk about as we get into these strategies. They can be used for both bearish and bullish, and also there are ways you can apply these when you are in a neutral outlook also, and before you put them on. So how eOption can help improve your bottom line also is obviously something we're going to show you, because since they have such very low commissions for your options trading, that right off the bat is one way to help you with that. So why stock option strategies? Well, the first thing is you lower your cost basis. At eOption, it is only 10 cents a contract, much lower than other firms. Option spreads help you diversify your portfolio because you can trade a much broader range of stocks with your allocated capital. As we get into some of these names and you see how much these stocks cost, it'll become very clear to you how options all of a sudden make these stocks something that you can participate in a different fashion. So option spreads allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. In both the stock and option pricing, the spread is typically very tight, and this is a very important cost control. Why is it an important cost control? It gets back to how do we increase your bottom line. The more liquid the market, the higher the spreads. That means that as you're getting in and out of your options contracts, that your pricing is going to be better for you. When your pricing is better, that means that your profitability is better. It also means that in the event that you lose, which losing is something that does happen, you don't lose as much. So that's something that you want to always take into consideration as, like, when we go over these strategies, the reasons we're looking at these particular examples isn't to promote these particular equities. They just happen to be highly liquid stocks, and they also have very highly liquid option markets. And once again, this is a way of controlling a cost. And when you can control a cost, that's something that's very important in trading, especially with options, because it's one of the few things that you have the ability to control, where you have the ability of whether it's going to be a good outcome or a bad outcome. So we're going to discuss that more with our examples. So trading in these products is similar to trading in normal equities, but with a higher potential ROI. So you will definitely see that in very simple math as we get into this. Today's focus, straddles and strangles. These are very, very simplistic option strategies, and we are going to give you a breakdown on how they first work, and then we're going to show you through some examples very simply how you can apply them and how you can expand your portfolio by using these strategies. So first of all, one of the main things is there's no margin. That is a big deal. So when it comes to option strategies and option spreads, there are some that will require margin. Margin means that you have to have more capital. The more capital you use, obviously, the less you can do, depending on what markets you're trading and how volatile things are. And especially right now, we have a very, very high volatile market. The VIX is something that is an indicator of market volatility. It's been very high for months for multiple reasons, especially we know from the geopolitical global impacts of the COVID-19 pandemic and things like that, how it's had the ripple effects. So defined risk, that's another reason why we're talking about straddles and strangles today. So besides the no margin, defined risk, this is something that's very, very big. Remember what I was mentioning in the last slide about controls? This is something else where you have the control. So outside of that, things start to get a little more sketchy because none of us can control the market. But if you can control your costs, if you can control how you get in and out of your trades, which is also part of controlling your costs, and then if you can define your risk, locking in what your potential loss is, or your capital that you're allocating for a potential risk reward, that is something that is huge. So these are variables that are all in your control. And they're also simple execution. That's the next stage. That's another reason why we like straddles and strangles. Very simply executed. And then also it's a volatility play. And this is where right now we're in a volatile market. And this is something where you can take advantage of it, because volatility plays can go for you and they can go against you. And we're going to show you how these can work for you, and actually how you use the current volatility with these strategies, because it actually fits the current market environment. So with that, we're going to start to look at something visual that you're going to have more something where your eyes will be like, okay, what are we looking at here? So Boeing Company, BA. Boeing is a company that is, if it's not on the radio, it's on the news, it's in the TV or somewhere every single day, it seems like, from the MAX Jet 737, right? And as you can see, besides the fact of the volatility that every market has seen over the current past 4 or 5 months, Boeing has not been any different. Now, when we started this, the idea for this webinar, now we're at the end of July, I picked the Friday, the July 10th, just to be our marker for the options. So all the examples we're going to use today are based off of August options, which usually when you want to put on a spread like this, you want to have 30 to 45 days out minimal. And pretty much that's a good range for most straddle and strangle plays. If you want to go out for much longer months, that would be a more advanced lesson. So, but for when you're considering the volatility, when we started this marker here on July 10th, it was a perfect time because we'd seen such extremes. The market had started to consolidate. And ironically, as you can see, this gray line here that separates this whole middle of the chart, there's an arrow. It says piercing line buy signal. This is actually a Japanese candlestick pattern that is a reversal signal. So let's just say that whether you're bullish or not, because of the high volatility and expecting higher volatility at this point, why this would be why we would put on a straddle or a strangle. So now the definition of a straddle is when you are buying and both a put and a call at the same strike price. Okay, so in our example here, you see we have our straddle. It equals buy the 180 call and buy the 180 put. So when our example here with this little black arrow here on July 10th, the market was trading right around $179.96, so just below $180. So 180 is a strike price for the options, okay, just like 175 is also. So there's the options are priced out in strikes of $5 increments, okay? So now when you do a straddle, what you're doing is you're trading both of the same strike price. You're buying both the call and the put once again. It's the same strike. Now, at the moment of this slide, when we first came up with this webinar, the market was trading just below 180. So the straddle would be the 180 call and the 180 future. Now, if you were to buy the stock, you would be paying just below $180 a share. Okay, so for 100 shares, and we'll get into the example, that would be our baseline for what we're looking at. Now, for a strangle is very, very similar. However, the strangle uses 2 option strike prices. So in this example, we would be using the 180 call, which is the same as we used in the straddle. So 180, when the straddle, we only use the 180 strike price. In the strangle, we use the 180 and the 175. And then so for when we buy the put, that's where we use the lower strike price. So your upper strike price is your call, and your lower strike price is your put when it comes to your strangle. Okay, so just remember, a straddle is the same option, and a strangle is where you use 2 options. Okay, so now at this point, for this example, the market's at basically 180. So what does that mean for this option spread? So when you buy a straddle or a strangle, you're looking for the market to move. Now, you may be bullish, you may be bearish, or you may not have a clue about which way it's going to go, but you just expect volatility for one to increase and also for market movement to continue to increase. So now in this example, we have a potential buy signal with this one pattern. Now there could be other reasons why you would be bullish here, or maybe you would be bearish, because for either example, whether you're bullish or bearish, so let's say this buy signal is incorrect and it fails, well then it still works out for this trade. So for those of you that are following or didn't quite get that, yes. So in this example, let's say you had a buy signal. okay, and it fails, for both the straddle and the strangle, you would be able to profit off of that move no matter what. Okay, so now if the market goes nowhere, that's where you would not make any money. And the reason you wouldn't be making money is there's multiple factors in option pricing. One is your time decay. So no matter what, over time, you would be losing money. Now, over a couple days, it's not very nominal. Over the course of a month, especially for options like these that are 30 to 45 days out, then you're using up a big part of your time premium. So you need market movement to absorb time premium no matter what. Otherwise, that part will start to decay. And especially since you're purchasing these options, you want to sell them for more than you purchased them. So in order to sell them for a profit, you need to have market movement that will erase your time decay. And then also you have your market volatility. So in this example, the reason we pick for this webinar is we're in a market where we have high volatility with expectations of even increasing uncertain volatility. And that's a reason why you would use straddles and strangles as an option play for this market environment. So not only is it strategically aligned for the conditions of the market, it also is a way of, if you remember from the beginning of the webinar when we explained how the strategy works, there's no margin. So you only have the cost of the spread to put up, and we're going to get into that right now. So now that we've covered Boeing, the stock, okay, so remember we said for 100 shares at 178.44 was the cost. So that would mean that if you wanted to buy 100 shares, so that would mean that you would have to be bullish. So whether you would like that buy signal from that piercing line, or if you had some other reason that you wanted to buy Boeing, maybe you think that their MAX jet that is going to finally work and I pass all the regulations and new tests and what have you, or for whatever reason. And so if you wanted to, it would cost you $17,844 just to buy 100 shares. That's one block. Now, that could be a lot of money to some. It may not be a lot to others, but no matter what, it's not a cheap stock. It definitely is $17,000, almost $18,000 to put the position on. Now, if you buy the straddle, remember that is where you buy both the call and the put. In this example, if you were to buy at that same time period on June 10th, the 180 call, it would have cost you $15.70. Now remember, when it comes to options pricing, it's a multiple of 100. So we'll break this down as we get through this straddle. So the 180 put equals $17.92 basically. So the cost to buy the straddle would be 33.625, which basically equates to $3,362.50. So that's how much it would cost to buy that one strike price at both the call and the put. Now remember, in this example, if you buy the stock, you have to be bullish, or why would you be doing it? Because if the stock doesn't move, then you're just sitting on $17,800, and hopefully they are paying a dividend, which I think actually their dividend may be, if it's not reduced, it may actually be suspended right now. So I don't think buying the stock, unless it does go up, that's the only way you can make money right now, especially in the current volatility and the market, the way the market is trading right now. Now, if you buy the straddle and the market goes up, well, then you would make money just like you would on the stock, except you didn't have to put out $17,000 to do it. So now as the market does go up, obviously you would be making money on your 180 call and you would be losing money on your 180 put. So that's where you need your market movement to continue to move enough to cover the cost of your option straddle, and for what you paid for it at the time versus what the value is as the market moves. So now in this example also, we have the strangle. Now the strangle is just like the straddle, but remember you use two strike prices. You use a call and a put from different strikes. In this example, we would use the 180 call because that's just above the stock price. And that's the thing, is that when you do a straddle, you might be right at the stock price, or you might be just above or just below the stock price, because you're using only one strike. They're both going to be relative in that perspective. Now with a strangle, you can wrap around, and that's a way where you can remember strangles versus straddles. Okay, so a straddle, you can remember it's all the same strike price, and it can be either above, right at the stock price, or below it. Now with a strangle, typically your call is above your stock price and your put is below your strike price. So in this example, the market was trading at 178.44. So that is right in between the 180 strike price and the 175 strike price. Perfect for this example, isn't that nice? So now in this case, the 180 call would be 15.7, $15.70, or basically $157. And then we have also your 175 put at 15.175. So when you add those together, you have a cost of 30.875. So it's a little bit lower than the cost of a straddle. And now that the price for that one at this time would be $3,087.50. Now, obviously, there's the price of your option commission, but that's only 10 cents. So there would be 20 cents right there, or $1.90 minimum if it's for, I think, one spread. So anyhow, in this example with the strangle, it does cost a little bit less. And then the market movements, you still need to have the market movement, but not quite as extreme as you do with the straddle. Okay, but then also the thing is with the strangle, for instance, let's say in this example, you were bullish. So instead of buying the stock, now the 170, the 175 put that you're buying is further away from the stock price than the 180 call is. So in that regards, you can see that the put is a little bit less than what you're paying on the call. So in that regards, where the 180 call appreciates, let's say, in your straddle example, let's say the market rallies $10, just to make it easy for you to think about. If the market rallies $10 in the straddle, well, you still lose more money on the put in the straddle than you would on the strangle, because the strangle put costs less. This one costs 15.175 versus the 17.95. So let's go into another example to make this start to look more easy. We'll go through keep each stock, and you'll see. In this case, Bank of America, once again, we have on the date of this July 10th, which all these examples are, we have a bullish engulfing line buy signal. Does that mean that we're bullish? No, we're not saying that Bank of America is a buy here by any means. But for this example, you could either say that, yes, this is a bullish time to get long Bank of America stock, or it would be time to put on a straddle or a strangle. One, because in this example, in all these examples we're getting to, there's been so much volatility that even if volatility was to drop off a little bit, implied volatility most likely isn't going to work against you too badly. And because markets typically don't just stop and flatline, odds are that you would still have, even if volatility starts to drop, market movement would continue, meaning you'd either have either an extension of a trend or a corrective move going the opposite way of whichever market had been trending. In this case, the market had been trending lower radically for a month. And that's the thing, is you got to look at the bell curve of the ranges. These stocks typically only trade, like this one, in $1-2 moves and ranges, typically on any given weekly period or even multi-week period. In this example, you can see that from the middle of May, the market went from $20 a share for Bank of America, or just above that, to $29 a share, to, in this example, where it had bottomed back to almost $22.50, and then here it's at $24. So this is all over the place. So there's definitely market movement, and that's what you want for straddles and strangles. You don't care which way the market goes. So this buy signal here, let's say you were bullish here and it fails. Who cares if it fails, as long as it continues to move and the trend continues? So the only thing here is we have different strike prices. This example is going to be a little bit easier for you to see, I think, than the last one. So this one, we have the market was at just around 24.14. We have the 24 strike price, and we have the 23 strike price. So for the straddle, once again, straddles are the same strike price for both the call and the put. You would be buying the 24 call and the 24 put, and then you would be buying the 23 strike and for the strangle trade. Okay, so for this one, you would be using the 23 and the 24 for the Strangle, and only the 24 strike price for the Straddle. So in this example here, 100 shares cost you $24. This is not such a big trade. This is not a big investment to buy 100 shares, $2,400. To buy the Straddle, it's only 310. See, look at how this is. Where before we were talking about 17, this is only 1.515 for the call, 1.59 for a put for the Straddle. That equals 3.105. You multiply times 100 for your pricing, and that equals $310. So for you to control the Straddle on this stock, that's not very much at all. Think about that. So for your lesser, smaller capitalized traders and options traders, you may not be priced in for the first example, but now all of a sudden for this example, you have the ability to, where maybe you could invest the stock if you were bullish, but you're like, hey, I don't know if in this market environment, if I really want to wait, maybe there's going to be another big dip in the economy, another shutdown, who knows? And that's where these straddle and strangles come on. We've been living in 2020 where you can't pick your vacation 2 months from now, let alone try and figure out market direction in many cases. So this is something where we know the markets are moving, so we can take advantage of that, because that's what these spreads do. So in this case, the Strangle here would only be $263. So that would be a cost, if you think about this, you're looking at 10% of that cost of what it would cost to buy the stock. You can control the movement going in either direction, okay? So now, here's United Airlines. I don't know about you, but I had one of my vacations canceled this year and been trying to plan another one, and it hasn't been that easy, although I have to say some of the deals to fly around the country are good. Of course, mine were to go out of the country, and those dreams are kiboshed. So for this one, though, United Airlines, you can capitalize on this. So the Straddle at this time of this webinar was at 33, was our strike price for the Straddle, and we used the 33 and 32 strike prices for our Strangle. And why is that? Because the market was trading at the time of this example in between these two strike prices. Now, here's something I want you to look at too. All these examples I've been showing you, there's the middle gray line going through them. If you notice how just in a couple of days, the market moved significantly. And so the question is, how long do you hold these on for? So let's say United Airlines, let's say you were bullish this stock. You're going to put up your $3,200, okay, because remember, stock price is $32.67, so times 100. Or you could put on your Straddle and Strangle trade here. So remember, with the United Airlines, you're thinking, like, if you just think about what I just said, a lot of people are driving this year. Maybe not everyone's going to be flying across the country, you know, so, and we don't know when these bans are going to be lifted. So it's really hard to be a bull with the United Airlines. If anything, is you're looking to probably buy the dips, you know, maybe it's already already factored in, and maybe the low, the best low for you all is already in place for a long time. You know, hopefully it is, as far as for the market's concerned, but we don't know, and we don't care when it comes to these straddles and strangles strategies. So once again, look at this. For $3,200, you can control a stock to be long, most likely not get a dividend, or it's a decreasing dividend, and have the risk of downside risk for quite a bit. Or you could put on the Straddle and Strangle for a relatively cost-effective pricing and expect the market movement. So now we have Microsoft, another high flyer. At the time of this slide, the market had just made a recent higher move high and was just floating right below it. So the 215 strike price is our single strike price for our Straddle, where you buy both the call and the put for the 215 strike. And the Straddle, or Strangle, excuse me, is the 215, 210 Strangle, where the market is trading in between that. And you can see that from the day of when these pricing would have gone off on, just a day after, 2 days later, the market traded. I mean, it was trading between 215 and 210, and then it had gotten just above $200. So it had a 5% move within just a couple days. So this is the thing where these trades, you may have them on for a few days, or you may have the ability to have them on for a few weeks to a month and a half. And that's just something you have to think about. Like, as we get into some of these stocks where they're trading on their highs and have been railing and railing and railing, well, no market goes in one direction. these are great ways to catch corrective moves where you wouldn't be able to do with if you were just long the stock. In this example, Microsoft, $213.67 for the per share. So that's $21,367 for 100 shares. The Straddle you could buy for just over $2,000, and the Strangle you could buy for just over $1,800. So you can see that you have the ability to participate in market movement in Microsoft, where if you only bought the stock or you didn't use the options, that's pretty much the only thing you could do is buy the stock, and either if you're buying in 100-lot increments or whatever you could afford. Versus with the options, you can utilize the market movement and the current market situations and capitalize on that. And the good thing with this is you don't even have to pick the direction. So all it has to do is move. Not that the markets can't ever flatline. They do, and sometimes they do get settled into range bound patterns. However, right now with the extreme volatility, you're not seeing so much of that. So now we're looking at Tesla. So everyone knows Tesla because they see the cars driving on the road. So this was a great stock to use for this webinar, because at the time of it, Tesla had been just screaming higher. I mean, it went from $1,000 to over almost $1,800 in the period of just over a week and a half. That's insane. It's just absolutely insane, the volatility of this stock. The option pricing on this is where things get expensive. Now think about this. The straddle for this, when I made this slide, would be the straddle would be 1550. So you'd be buying the 1515 call and buying the 1550 put. The strangle would be the 1550 call and the 1540 put. So to put this into perspective, and think about this for all of you that you missed out buying Tesla for only $1,000 5 years ago, where you would have been able to buy a lot of shares. To buy 100 shares of Tesla at the time of this slide, it would cost you $154,465. I don't know about you, but to a lot of people, that's probably a lot of money. The straddles and the strangles is something that can help you participate in this market, but then even still, that's where you have some costs too, because volatility is so high in this market, and this is something that you have to think about. You don't want to buy straddles and strangles when markets are so overdone and over-exacerbated. The examples we showed you before, you had the potential with market movement to make money, and you had time on your favor. But when you have volatility that is so extreme, and I mentioned, in the last slide, I said that Tesla had rallied from 1,000 to almost 1,800 in a week and a half. That's ridiculous. That is absolutely extreme for any stock, especially a major industrialized stock. So to put this into more perspective, think about this. Your return on these options, this slide was done on a Friday. When this was done, the stock was trading at 1544. The following day, the following Monday, the stock opened up over $100 higher. To give you an idea of the type of market movement straddles and strangles can make, especially when they kick, the 1550 call, if you can look at in the center here, I'm circling at the 1550. It was 213.25 for the puts, and it was 92. It was 205.65 for the calls. Now the difference of 1550, all you got to do is look at the negative and the positive. For the calls and the puts here, this was a minus 58.4. This was plus 92.8. This was an increase of over 25% on your option spread in the course of a weekend. That is an amazing return, basically overnight. Now, obviously for Tesla, you would have to have had a lot of capital up. So let's come back down to earth a little bit to something that, oh wait, this is another expensive stock. Not completely back down to earth. Amazon too, look at the volatility on this example. This example, the market was trading between 3,200 and 3,190. The market, Amazon traded to above 3,300 the following day and then settled lower, and then 2 days later was below 3,000. This is where it straddles and strangles, is where it can make you money. But when you're playing these big stocks, even these straddles, these spreads are expensive. So for here, the straddle would be, once again, the single strike price of 3,200, which would be the call and the put. And then we have for the strangle would be the 3,200 call and the 3,190 put. Now in this example, Amazon, and for 100 shares, it would cost $3,200. excuse me, $3,200 a share, and that's $320,000 for just 100 shares. Very, very, very expensive. So this is even more expensive than Tesla, but Tesla's getting there. The Straddles and Strangles on this one, even though these numbers are big, $43,580 is nothing compared to laying out $320,000, right? So the funny thing is, think about this. If you put on the Straddle that Friday when the slide was made, 43,580 gained over 25% within the course of, this would be on the close of Friday to the opening of Monday. That was just insane. And that's where, you know, you may, you lose 2 days of time decay, but wow, when market volatility increases and you have that kind of market movement, that's when you see those kinds of return very quickly. And that's also when you would get out of those options. This is something you need to think about. These options, they cost a lot of money, whether they're this one or we have the examples where they're much, much cheaper. It doesn't matter what the cost is. Your profit is always relative. If you make a 20 to 25% return in a time period such as like these spreads have moved in the course of a few days, you get out of those spreads. If anything, you rotate into other ones, or you take your money and you run and you wait for another moment to put on new spreads. Reason being is every other variables that work against you. And when you have a high return in a short amount of time, that's the one time you can throw in a control on a variables that you usually don't have the ability to. It's basically like if you're up at the tables in Vegas and you had a big run and you just got there, you stop right away. Most people won't do that. So that's the discipline you need to have, and it's rational expectations. If you made 25% on your money, whether it was $43,580 for the Straddle or $42,000 for the Strangle in this example, or if it was $400, why wouldn't you take your money and run? It just makes sense. So here we have Roku. Here's another example of a Straddle and a Strangle for you. This market had a nice run up since June, and is definitely one of those high-flying tech stocks that is in play right now. At the time of this example, the market was trading around $153 a share, and the strike prices that we're going to use for this example would be the 155 strike for the Straddle, which is above that market price, and then also the 150.55 strikes for the Strangle. So once again, you would buy and sell, or buy the put and the call at the 155 strike price for the Straddle, and for the Strangle, you buy the 155 put call, and you'd buy the 150 put, and that's surrounding the strike price of the market. Remember, usually, excuse me, you will have your stock price right in between those different options prices. Excuse me. So now let's look at the pricing on this. So coming back to earth here, $153 a share. Wow, it's much different than $3,000, right? It only cost you $15,300 to buy the stock, but the stock had a nice run up, and we have all kinds of uncertainty in the market environment. Unless you're looking for a super long-term investment, maybe buying the stock is not the way to go. Maybe buying the Straddle or the Strangle is the way to go. In this case, buying the 155 call and buying the 155 put, it would have cost you just over $3,500. To buy the Strangle, it would have cost you just over $3,200. Now, the thing about this is to have a nice little movement, the stock, for it to move 5-10% when it's been moving 10% in swings over the course of just a few months. This is a situation where you're getting fine value. So even though these spreads are still expensive, it allows someone to participate in Roku and not having to worry about things that, remember, we're in a dividend cutting environment. Even if earnings are up, to maintain stock pricing up, it doesn't mean the dividends are going to be going up. And even if earnings are holding strong in many companies, they're not increasing their dividends. In fact, many of them are cutting them or putting them on hold. So dividends is something, buying stock is a different type of thing right now. You're not where you would be normally putting buying dividend stocks because of they pay dividends, and you want to do that in a harsh environment or an uncertain economic environment. all bets are off for this environment because we don't know how dividends are going to play into this, let alone if they're going to hold. So then buying is the only way to look at it. If you're just going to be long, that's one directional. If the market goes down, you're going to take heat, you're going to be down money, and you're going to have money sitting there that is not making you money. So the straddle and the strangle, once again, it gives you that opportunity in these more expensive stocks to be a participant in that market. So now then we have Facebook. So now this one here is, everyone is familiar with Facebook. For this one, we're going to use the 250 and the 245. Now for this one, we're using the 245 call and put for the straddle, and for the strangle, we're using the 250 and 245 strike price. In this example, to buy Facebook, 100 shares would cost you $24,500, a little over that. And for the straddle, you'd be able to get into it for $2,900, and for the strangle, $2,700. Once again, you look at the math on this one. Facebook, you hear everything from how their advertising revenue has been getting strangled because of certain regulations and things like that. You don't know if this is going to continue to be a high-flying tech stock, or is it going to get crushed because its earnings are going to fall apart. Then you have the whole thing with the election, which you can and can't run for ads, which goes into another thing. And when it comes to Facebook, everything they give away is for free for people to connect it, but they use it for marketing and for those ads, and that revenue is where they generate all of their money. And for that to be strangled, that doesn't make good for, even if the NASDAQ is going up, that doesn't mean that Facebook's going to continue to go up. So for this one, Facebook, exactly, straddle and strangle, talk about a great way to trade Facebook. Because if you're going to invest in it right now, being a bull, that's more of a long-term strategy that you're going to have to stick with, because, well, maybe it goes straight up from here. I don't know. But right now, there's variables that none of us can have any control over, and they're definitely going to be impacting the price of Facebook over the next 3 to 6 months. Knowing that even if market volatility drops, and Facebook volatility most likely is going to be up, straddles and strangles, once again, is another good way to go with this market and look at the cost. You're looking at less than or just over 10% of the cost of buying the shares. And in this case, you don't care if if Facebook goes to the moon or if it pulls back 25%. You're just looking for some market movement. Same thing as with Apple here. Once again, with these other stocks where they have been very volatile, this market had been a bull, just trending higher, just like Tesla. Markets don't go in a straight line forever, and they don't keep going up forever. They definitely have corrections. So in this example, we would use the 380 call and put for our straddle, and we'd use the 385 call and the 380 put strike price for your strangle. For this example, you would be buying the stock at $383 a share. That's $38,368 per 100 shares. However, for the straddle and the strangle, your costs are much, much different. Once again, with this one, your cost would be $3,600, just under $3,700 for a straddle, and $3,400 for a strangle. And for this market movement, think about this. Apple trading on its highs at the time of this thing. It could be going, obviously, continuing to go higher. Apple is another market, too, that has had some issues with some pricing, and they have some lawsuits they're dealing with. But as a most part, their company is doing well. But who knows how things are going to go with the China trade deal and how things hold up with that. So, I mean, is Apple overdone? I think it's always looking for a dip to buy. And Apple right now, like I said, you don't want to be picking market direction. And with the high volatility, and if you see how the NASDAQ, has given reasons for a corrective move back, what happens if profit taking comes in, especially since we got into quarterly numbers. Now it's time to, take profits and then see where things go, which causes corrections. Now, not necessarily turning this market to a bear, but it means that straddles and strangles, a volatility play, is something that's ripe for action. And buying this versus buying the stock, which unless the stock goes up, you're going to take heat. So now let's look at Netflix. This is one of our last examples here. In this example here, you would be buying the buying the 545 call and the 545 put, and for the strangle you'd be doing the 550 call and the 545 put. On this example, you can see that the market was trading in between those strikes, and then the following day it shot up over almost $30, and then came back to settle lower on the day, 2 days later, it's trading below $500. Netflix, in a period of just 2 days, you would have been able to capitalize on both these straddles and strangles. Now, the reality is you can see how much volatility is going on in the market when the cost of this options. Look at this. $54,873 would be the cost for 100 shares. Now, the straddle and the strangle, both here, the straddle is at $7,900, the strangle is at $7,600. That's very expensive. That's not quite 20%, but remember before most of our options spreads were around 10% of the cost of buying the stock. This is much higher. So that shows you how much volatility is in this and how much movement is expected. So no matter what, the price of these options may be expensive, but movement, when you have pricing like this, it's usually a time when markets do not flatline. So Netflix at the time of this was at 548, and just to give you an idea, today it was trading at 488 this morning when I looked at it. So that is a $60 move in the course of just a few weeks that you would have been able to capitalize on this Netflix. And had you bought this stock, which everyone's bullish Netflix, you would be down right now $60 a share, $6,000, which would have been almost as much as what it would have cost to put on a straddle or a strangle that right now you could get out of at a profit. Isn't that something? Is this starting to make sense? We're ending on a note where I hope you see how straddles and strangles are something, how you can participate in high-flying markets, make a high return, and capitalize within both a short and a longer-term target. And you have the ability to trade multiple directions with no margin, knowing your defined risk, knowing your defined cost, and knowing that you don't have to be right on direction whatsoever. Because if you buy the stock and you're happy with Netflix right now, over the past 3 weeks, you would be saying, oh, I guess I should have waited 3 weeks, or I guess you can buy more and spend like, only 50 grand a share, or 40 some thousand, or $48,000 for a block of that. So with that, I hope you've enjoyed this webinar. We're going to answer some questions now. And if you have a chance to check out the book, High Probable Japanese Candlestick Patterns, that's the book that I'd written that Gina had spoken about. You can check it out on Amazon.com in paperback and Kindle version, and then you can see how those signals I talked about in a couple of those examples, how you would trade them. And also, before we get to the questions, remember you can maximize your option trading potential. Use eOption for your stock, ETF, and ETF option trading. Free option strategy tools like Options Play are available to you. Free option strategy guidebook available at eOption.com. Free paper trading account to test your strategies. ETF and stock trades are commission free, and option contract commissions are only 10 cents a contract at eOption. So, questions about the webinar, option strategies and applications, anybody? And remember to like eOption on Facebook to get advance notice of future webinars, latest marketing news, and investing tips. So let's see, on the Zoom thing right here, I don't see any. Let me see if there's any. Oh, here we go. Sorry, I had this out the wrong way. Oh, now all of a sudden I got the questions. Okay, here we go. Real quickly, we have from Ken. Ken, does the call have to be in the money? Remember, when it comes to the straddles and strangles, you need them to be, well, for the straddles, it's going to be same option price, and for the strangle, you're going to have one is going to be above the market and one is going to be below the market. Now, as far as in the money, remember you're going to be trading 30 to 45 days out. So in the money, yes, you're going to have one that will be typically in the money. So that would be when you have your straddle, where you have the same option, it's the same strike price, one of the market, unless it is at the market, like for instance, for Tesla, or for example, let's say at $15.50 a share, if it's $15.50 and you're doing the $15.50 straddle, then you're buying the call and the put the same, so they're right there, they're at the money. But for when you're using certain straddles, then if the stock price is above, then obviously you're going to be in the money for your call, or vice versa for your put. So I hope that answers that question. Then we have for Godfrey, normal option, the closer you get to strike date, time kills value movement. Does this happen in straddles? Let's see, normal option, the closer you get to strike date, time kills your value movement. Does this happen in straddles and strangles? Yes, it does. But that is why, for all these examples, I said that you always trade for this kind of strategy 30 to 45 days out. So in that case, you do have time on your side. And think about that. This is a very good question that Godfrey asked. You know how I said, like, some of these, because the extreme market movers like Tesla and like Roku, or even the last one we did with Netflix, when you have a market that has been up and just appreciating, not just on a monthly basis, but on a daily basis, just so exuberantly, markets go out like they come in. You know, they don't just go in one way forever. You know, so, and that's where when you put these volatility plays on the straddle or strangle, for instance, where 3 days later the market moves so far that you can make 25 to 40% on your option. Think about this. In a 3 to 4 day time frame, if your options, if they were shorter term options, like Godfrey would be saying, like if you had only a week or two left, you would be losing money on time decay. But when they're 30 to 45 days out and you've only used up 2 or 3 days, your time variable is next to nothing. So especially if you have extreme market movement, your time decay is nominal. So that's nothing. So that's something where, yes, you do have an impact with that. And that's why you want to use the further out ones, because unless you have to wait for 4 to 5 weeks for that market movement to be achieved, in which case, if it does, then you'd still absorb that time decay from the market movement. So very good question by Godfrey. That's really good. And that also gets back to why I said earlier, if you make 25, especially at 40% in 2-3 days or over the weekend, get out, take your money, call it a day, and look for something another day. Not to be rhyming there. All right, and that's for Mr. Anonymous. Can you share an example of profit potential in a straddle or strangle? I think I did in the last couple examples, especially as I got to the Netflix example where the market had moved $60 in the course of, from time when I did the slide to today, which was the course of the 2.5 weeks. So I think that should have been covered there, because that way you could see how the only way, if you had bought the stock versus putting on the options, you would not have made any money whatsoever. And versus with the option strategies, with the straddle or strangle, you would have capitalized significantly on that trade. We got 2 last questions to go through and then we're done. In the first slide, there was a buy point. Is it arbitrary? No. Remember, for the straddles, they're the same strike price. You typically want to have it. Now, if you're in a bullish market and the market has been rallying and rallying and rallying, then you might want to have it if it's slightly above the stock price and you're heading up into it. That would be a good way to do it. Or you could even go to the lower strike price, thinking that if you're ready for a turn, like if you had a sell signal, or like in this example, I had 2 or 3 of them with buy signals. In that case, you would want to use the lower strike price for your straddle, because you're looking for a rally, so you'd want to see the biggest return on your call and you want to pay the least for your put. So that's why you'd want to use the lower one in a buy, and the conversely for the selling side. Let's see, Majo, please walk us through why our strangles are not even at price of stock and more directional. Let me see, please, why your strangles are not even at price or stock and more directional. Why are they directional? Because they are directional spreads. You're not, when you, for the buy spread, that's why I use those. They weren't arbitrary for the buying ones. Those were put because you want to have the stock price in between your strangles. And usually when I have that sets my, my zone for what I would want to use for a straddle. So for a strangle, if I'm putting on a strangle and it's a buying situation, then where my call is at, that would be my strike price that I would use for straddles, and then strangles obviously surround the stock price. And conversely, for a sale, if I had a sell signal, I would use the lower strike price for my straddles, and then I would use a strangle in the opposite fashion. So with that, I think I can turn it over to Gina and Scott if he's there, because I think we're out of questions unless they have another one. Actually, sorry, I guess there is one. What is option website address? eOption.com. That would be your website address for to get this webinar and see the past ones and other information. And let's see, do you have a video to learn how to use option software? That is also on the eOption.com website. And let's see, what's the web address? There you go. Okay, cool. I think everyone got those questions answered.
Okay, great. Well, thank you so much, Teddy, and thank you to everyone for attending the webinar and for all of your questions. And if you have additional questions, you can feel free to call eOptions Trade Desk at any time, and they'll be happy to answer your questions as well. Also, a recording of this webinar will be available on our website in the next week at eoption.com. And to all attendees of this webinar, we will send you an email with the recording as well, so you can view it at your convenience. And if everyone can mark their calendars for our next webinar, we are having, it's called Understanding the Greeks, Delta and Gamma, sponsored by the Option Industry Council. We did have part 1 earlier this month. And so this will be part 2, getting into a few other Greeks, Delta and Gamma. So again, that's August 25th on a Tuesday at 1 p.m. Central Time. If you go to eoption.com, we do have a webinar and video tab, and you can sign up there. And if you missed part 1, it's not a prerequisite to attend part 2, but if you missed it, you can also go to our website and under eoption.com, and you will see a recording of part 1 there if you'd like to view that before the next webinar. And as Teddy mentioned, eoption.com is a plethora of information. We have lots of education on there. We have strategy links, so you can click on a straddle or a strangle, and it'll go into a chart, when to use it, the benefits, the market outlook. So that's a tremendous resource, and that's provided by the Option Industry Council. And we just recently updated all of that with them. Also on eoption.com, there are lots of instructional videos on various option strategies if you want to use covered calls or various spreads, or how to trade in a bearish market. And so there's lots of great information on there as well. Also, how to use our platform if you're new to eOption and you want to find out a little bit more about how to use it. We also do have free tools on there to help you set up your trade. As Teddy mentioned, we do have a wonderful tool called Options Play that scans through thousands of stocks every day and helps you set up the right option trade to meet your goals. And there is normally a fee for that, but that is free for all eOption accounts. And we get a lot of great feedback, and a lot of our customers do use that service. And we hope that you found this session informational, instructional today, and that you'll give us a try. And as Teddy mentioned, if you want to give Straddles and Strangles a try, our option trades are some of the lowest in the industry. It's just 10 cents a contract plus $1.99 per trade, where if you traded 10 contracts at eOption, that would just be $2.99 your commission, where a lot of the big competitors, that would be more than double for 10 contracts. And all stock and ETF trades are commission free. And as it says on the screen, remember to like eOption on Facebook. And if you want to get advance notice of more webinars like this, market news, investing tips, and we get a lot of great feedback. So we hope you'll connect with us on Facebook and stay in touch with us. So again, thank you again for attending. We greatly appreciate it. And thank you to our speaker, Teddy. And we hope to see you in a few weeks. Thank you. Bye now.